You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW
Hello, welcome to the Investor Way with me, Sam Ball, and my co-host John McEwen. It's the 16th of February 2025, and in this week's episode, we'll be discussing AstraZeneca, Diageo, GlaxoSmithKline, Vodafone, Novo Nordisk, and Disney. John, should I start us off with our first pharmaceutical company of the week?
Yeah, absolutely. Kick us off with AstraZeneca.
So, AstraZeneca have come out with their full year results, and fourth quarter revenue was up by 25% to $14.9 billion, and all the figures were reported in dollars. That saw full year growth rates reach 21% ahead of the high teens guidance, and there was broad-based growth across all the key therapeutic areas, with particularly strong performances from cancer treatments as well as the respiratory and immunology division. Underlying operating profit grew by 58% to 4.2 billion as revenue growth outpaced the increase in expenses. Free cash flow for the year increased by 1 billion to 9.9 billion, with net debt falling from 24.6 to 22.5 billion. The company declared a dividend of $2.10 per share, with the total payout relating to 2024 rising 7% to $3.10 for the full year. 2025 guidance was higher than expected, and revenue is expected to increase by high single digits and underlying earnings per share by low double digits. The shares were up 5% following the results. AstraZeneca targeting an 80 billion revenue target and a mid-30s operating margin by 2030. I think that operating margin, mid-30s, should be achievable. So we'll come on to it later. But Novo Nordisk's is about 40%. So it's definitely possible if the company is well run enough. And AstraZeneca also have a diverse late-stage pipeline. Ultomiris, which was acquired with the acquisition of rare disease specialist Alexion last year, saw sales grow 34%. Farxiga, which treats cardiovascular disease, kidney problems, and type 2 diabetes, is growing strongly too. Net debt currently sits at about 1.2x forecasted cash profits. And they also gave an update on the launch of investigations by the Chinese authorities into the business practices of current and former employees. So the company itself is now facing a probe into unpaid import taxes, whereas previously the investigation was just restricted to the former employees and not the company itself. In terms of the price, the business trades at a forward P of 15.4, and that compares to a 10-year average of 18.2. Prospective dividend yield for the next 12 months is 2.4%, and that compares to a 10-year average of 3.3. I think these are a very good set of results. I think AstraZeneca has been putting up good results for a while now. Last year's acquisition looks like it's ticking along quite nicely. And I don't think the debt's looking too bad either. I think 1.2x cash profits or forecasted cash profits is not an unreasonable amount. My only issue would be I don't think they're going to sustain revenue growth of 25%. 15.4 times earnings, it's not outrageous. But then if you think it's going to be low growth, you would expect a decent dividend. And I don't think 2.4% is particularly high. And this is something I would view as a stock that should be an income stock, just because unless there's something in the pipeline that I don't know about, which is entirely possible, because as I frequently say when we cover these companies, I really struggle analyzing the pipelines. But unless there's some miracle drug in there, I'd want more than a 2.4% dividend, unless there was something in there that suggested there's going to be huge capital growth. John, what do you think?
I mean, I thought these were a very good set of results. I don't think you could really criticize it. I think it's difficult to know in terms of accurately valuing it unless you do have quite specialist knowledge of the pipeline. And that's something that I don't have. In terms of the dividend, I think historically the yield has been higher, but there's been a lot more share price growth and they haven't necessarily increased the dividend in line with the increasing revenue. So whether that's because there's more going into R&D and that's, the strategic reason behind it, I wouldn't necessarily be opposed to that if you're going to get greater long-term growth out of it. And Glaxo has changed in recent years, but it's that pure pharma play, which Glaxo didn't used to be, because it would have that sort of more consumer health division. And therefore, you'd have more fed back to you through dividends. But in short, I think AstraZeneca, it seems like a very well run company. It's got an excellent track record, and I think out of the British pharma companies, I think it's probably the one to have.
So, should we move away from pharma then for a few minutes and into Diageo?
Which is there is it's sort of linked actually with Funsmith saying that they are actually selling down Diageo as a result of some of the products that their main shareholding, which is Novo Nordisk, and the GLP-1 inhibitors, the sort of weight loss injections, are potentially, or they feel likely to impact on Diageo sales. But we'll come on to that again in a little bit. So Diageo, we covered it lots of times on the show. For anyone who doesn't know, it owns Johnny Walker, Tanqueray, Smirnoff Vodka, Guinness, and many, many others. It's probably got the best collection of spirit brands of any company. They had their half year results out last week with first half sales of around $10.9 billion coming in better than expected. And that reflected organic growth of 1% with the positive impact of price mix more than offsetting a small volume fall. Operating profit came in at $3.2 billion and was down 1.2% on an underlying basis, driven by an increase in overheads. Free cash flow was up from $1.6 billion to $1.7 billion as improved cash management more than offset an increase in investment spending, and net debt stood at $20 billion. The interim dividend was held flat at 40.5 cents a share, and ignoring the impact of tariffs, Diageo expects organic growth to accelerate in the second half and for margins to dip a little further. But they quote, given the current macroeconomic and geopolitical uncertainty in many of the key markets, medium-term guidance has been removed, and the shares were down 2.5% in early trading. In terms of valuation, Diageo has a market cap of just over £47.6 billion and trades at 17 times forward earnings compared with a 10-year average of 21.2, and it has a prospective dividend yield of 3.7%. I think these results were disappointing. They have been guiding along these lines, so it didn't come as a great surprise. It does have an excellent portfolio of brands, some of which I mentioned, Guinness and Don Julio being a couple particularly, and those are gaining market share, but there have been some regional headwinds, particularly in the US with flatlining growth and the strong price rises definitely taking their toll there. I think also changing attitudes towards alcohol, and commonly read articles in the paper talking about Gen Z and them consuming a lot less in terms of volume. I suppose these companies, including, brewing companies and spirits companies, including Diageo, have come up with non-alcoholic alternatives, but even with those, the volumes have dropped. Then there's the GLP-1s, and that's what Terry Smith cited as one of the reasons that he sold down on Diageo, in that he thinks that with that particular class of medications, as they become more popular, it'll reduce volume consumption even further. I think looking broadly on the geographical areas, Asia Pacific and India in particular, with Africa, they've been particularly positive, but it had been difficult in the huge market that's China. I do have Diageo shares. Initially, I wasn't too concerned, but I think it's definitely an interesting point that Terry Smith makes in terms of those GLP-1 and sort of weight loss injections. You can get oral forms of those too, and I think that you do wonder about the longer term trends there, and I think whether Gen Z is an exception or whether that's going to be a continued trend, that I think is a problem from Diageo. And to some degree, you can tackle that having more premium spirits and that being the strategy, which was working well previously. But whether that thesis is undermined, it's difficult to say. Certainly, by historic standards, the shares are cheaper. You wouldn't call them cheap at 17 times forward earnings, but they're cheaper than they have been historically. and you've got a more generous dividend. I appreciate that's always subject to change there. So I would hope that this is just temporary for Diageo, but there are those slight concerns there in the background. Sam, what do you think of these results and the future of Diageo?
I think the results are pretty in line with what we've seen for the past year or so. Although it's maybe stabilized a little bit. I think revenue flat is not terrible. It's not great. And at 17 times earnings, you'd want the company to be growing. But this is a company that was previously trading at like 35 times earnings. So I think it's interesting because, especially the points that you've made from Terry Smith. So I think in terms of the Gen Zs, and I think even the millennials to an extent, I think people do drink less now. But like you pointed out, if you're drinking less, you might drink more premium brands. And the premium brands are maybe better protected than, say, the Heinekens of this world, where like if you look at Heineken's brands, there's some very good brands, but it's just kind of lagers and ciders, which really need the volume. I think one interesting point is that if you are Gen Z and or if Gen Z are drinking less, premiumization is all well and good. But I think in terms of the non-alcoholics, well, I don't really know of anyone that would drink a non-alcoholic whiskey, whereas people will sit and drink a non-alcoholic cider. So in a way, if there's people who aren't drinking at all, I think the premium drinks are actually worse off because people will have a non-alcoholic beer or cider, but no one's going to pay however much Johnny Walker is without the alcohol. So that would be my concern with it. But in terms of the GLP-1s, I think that is less of a threat than Terry Smith is making out. And I don't know if that's partly naivety, but I just can't see a future where like the main way the population are controlling their weight is by injecting things. I think it's obviously there's a big future for these GLPs, but hopefully I would hope the norm is that people maintain a healthy weight by just maintaining a healthy weight and not by the solution shouldn't be injected, I don't think. I think there's only a very sort of specialist set of circumstances. And I understand that if that demand is there, Novo Nordisk could go in to fill it or whoever else. But I think the amount of people that would need to be taking these drugs for it to then have a knock-on effect seriously into the spirits market and the alcohol market, I just don't see it.
Mm.
But I don't know if that's maybe more in terms of, I think it would be a negative for society if it were to become that widespread. In terms of Diageo itself, I think at a forward P of 17, it's very, very attractive. So because of the valuation and the fact that the growth was maybe going to be mid to high single digits at best, it's a stock I've always liked but never owned. I still don't own it, but at forward P of 17, it's now gone on the watch list. And I
Ooh,
think it's something I could buy. If it stays like this, I could see myself buying it as soon as we enter the new tax year, potentially, if it's still like this.
interesting.
Because I think at 17, I struggle to, because especially when you've still got like Latin America and, the premiumization you've got, I know some of these markets have performed poorly in the last couple of years, but I still think there's a lot of run room, especially when I think Diageo has something like 4% of the world's spirits
Yeah,
market or something like
yeah,
something
yeah.
like that, and they want to get to 6, and I don't think it's an unreasonable target. And I think some of these concerns are slightly overblown in terms of like, especially when you think of the number of people that would have to be taking GLP-1s for it to then affect their appetite and desire to have alcohol, for it to have a serious effect on the alcohol companies. I just don't see it. And I think at around 17 times earnings, I think this is a stock where if it puts up a couple of good quarters with those quality brands, it's back at 25 times earnings in a flash. So yeah, it's gone on my watch list.
Yeah. I think on the non-alcoholic point, Tanqueray do quite a good non-alcoholic gin, and they also have 0% Guinness. So they are a couple of the ones. I appreciate not all the spirits are going to be like that, and whiskey I can't quite see, but I think some of them lend themselves more to that than others.
Yeah, I think gin's a good one. I think non-alcoholic gin, I can kind of see that because although it's quite expensive, if you're mixing it, it's sort of all right.
Mm.
Whereas no one's going to have a non-alcoholic whiskey on the rocks
Yeah, no. I would accept that. I would accept that.
with a tobacco-free cigar.
Well, fine. So let's move on then. It's GSK.
Yes, back to pharmaceutical. So GSK, the other main FTSE listed pharmaceutical company, that has been struggling more recently than AstraZeneca has. So it's probably been the worst performer of the two in recent history. So they've also come out with full year results. And revenue is up 7%, ignoring currency movements, to £31.4 billion. And that compares to 31.1 billion expected. Strong growth in specialty medicines more than offset a decline in vaccine sales. Underlying operating profit rose 11% to 9.1 billion, benefiting from a favourable mix of both products and regions. Free cash flow fell from 3.4 billion to 2.9 billion, reflecting 0.6 billion of settlement payments in the Zantac case. There remains a provision of 1.5 billion on the balance sheet for further similar payments. Net debt was down nearly 2 billion to 13.1 billion. Final dividend of 16p brings the annual total to 61p. It's expected to rise to 64p in 2025. A £2 billion share buyback programme has also just been launched. GSK expects top-line growth of 3 to 5% in 2025 and an uplift in operating profit of 6 to 8%, and the shares were up 5.6% following the results. In terms of the pipeline, GSK have seen 13 positive late-stage clinical updates so far this financial year, and they're expected to have 5 major products approvals next year. And these milestones have led to an upgrade of the medium-term outlook of at least 40 billion of annual sales expected by 2031. HIV treatments are making up about 20% of total revenue. And Apretude is an HIV drug that they're developing, and it's the only approved, well, actually, no, I think this has gone all the way now. So it's the only approved medicine in its class, and real world studies have shown it to be 99% effective at preventing HIV infections. Net debt has been coming down and now sits at about 1.2x forecast cash profit. So that's about the same as the AstraZeneca net debt, actually. And in terms of the valuation, the business trades at a forward P of just 8.3, and that compares to a 10-year average of 11. The prospective yield for the next 12 months is 4.7%, and that compares to a 10-year average of 5.8. I actually think these are a really good set of results, especially considering what we've been used to seeing from GSK and how it's been lagging AstraZeneca. I know the growth is still not as good as AstraZeneca's, but you can get it at a P of 8.3 compared to 15.4 for AstraZeneca, with a prospective yield of 4.7 compared to 2.4 for AstraZeneca. And now all of a sudden, the pipeline's looking a lot healthier. Now, this is probably, I think, a good illustration of why I struggle so much with these businesses, because whenever we've covered them, and I think it's fair to say we mainly cover them because there are listeners that may be interested, and they're quite interesting businesses to follow, but they're not, I think for both of us, I think it's fair to say these businesses do just go straight in the too hard pile because of the pipeline. And because of that, because we don't really have the skill set to analyze the pipelines ourselves, and it's certainly the case for me, we're kind of relying on industry analysis or articles or what other people are saying. And if you go back a year, 18 months ago, 2 years ago, and you listen to our coverage of GSK and AstraZeneca, which is based on articles rather than our own interpretation of the pipeline, the feeling around the pipeline for GSK was very, very negative compared to AstraZeneca's pipeline. There was a lot of criticism that GSK's pipeline was just not looking as good as AstraZeneca's, and that's partly reflected in the price. And then all of a sudden, and some of this could be luck, but then within a year, you've got 13 positive late stage developments, which just totally transforms the perception of the pipeline. Because all of a sudden, GSK's pipeline is now looking quite good, and it's still trading at a forward P of 8. And I think unless you actually had some kind of industry knowledge, and there might be an element of luck in that some stuff that maybe would have been expected to drop off hasn't. But although it's a really positive set of results, particularly in relation to the pipeline, I think it kind of emphasizes why these businesses are so hard to analyze. Because equally, there could be some with very positive pipelines that are just going to drop off, and you've got no way of knowing because you are relying on someone else's interpretation rather than doing your own analysis. So, John, what are your thoughts on the results and GSK?
I think very similar. And I think it does emphasize that you could have a thesis about pharmaceuticals and that you want exposure to pharmaceuticals and actually just take a basket approach to it. And that's probably the safest way of doing it, unless you're an expert and you can understand the industry in more depth. So I think that's, would probably for most people be the best thing.
Do you think it's interesting as well? I'll see what the share price has done. But in terms of the PE, it's still got a forward P of 8, which I think, given these results and how the pipeline's looking, seems quite low, especially given it's half of AstraZeneca's.
Mm.
And it's still actually below where it was a year ago. I guess it's because of the 1.5 billion that's set aside for the Zantac case. But even still, you'd think kind of once that's out the way, things look quite positive all of a sudden for GSK.
You would think so, but again, I think it does show our lack of understanding of the
Yeah.
industry and why we probably shouldn't be investing unless you are going to sort of do more of a basket and rather than picking the winner.
Should we move on to a business that's much easier to understand then?
Yeah, no, absolutely. So it's telecoms and it's Vodafone. They had a Q3 trading statement out last week with reported third quarter revenue growing 5% to 9.8 billion euros. Service revenue of 7.9 billion euros was up 5.2% on an organic basis, with a continued slowdown in Germany offset by growth in other Europe, Africa, and Turkey. And underlying cash profit rose 2.2% to 2.8 billion euros. Vodafone's UK merger with Three was approved in December last year, with completion expected soon. And the 8 billion euro sale of Vodafone Italy to Swisscom closed on the 31st of December, reducing net debt. Up to 2 billion euros in share buybacks is planned after the current programme. There were no changes to full year guidance of around 11 billion euros in underlying cash profit and at least 2.4 billion euros of underlying free cash flow. However, German profits are now expected to be lower in the second half, and then previously it was guided as flat. The shares were down around 5.7% in early trading. In terms of valuation, Vodafone has a market cap of £16.75 billion and trades at 9 times forward earnings compared with the 10-year average of nearly 20 and has a dividend yield of 6.1%. I thought these results they were okay. I think we've got used to them being pretty moderated, and actually, a couple of years ago they'd be very pleased with these results. It's not a business that you'd expect huge growth from. It's the mature end of the market in Europe. They do interestingly have a small African business. I think it's Vodacom, which has been doing very well. But that being said, it's a much, much smaller part of the business compared with a company that's nearly 17 billion pounds market cap. It's not one that really attracts me. I think it's something that requires it's very capital intensive, and the growth prospects just aren't there in the primary regions that it operates in. I know we like and both own Airtel Africa. That's a much riskier business, but then you do have the growth prospects there. So, yeah, I wouldn't be going near Vodafone. Sam, what are your thoughts?
Think these results are okay. There's nothing setting the world on fire, but they're sort of simplifying the business. They're getting rid of some regions that maybe aren't performing as well, paying down the debt. I saw they've cut the dividends to reflect the smaller business, but I think at a forward P of 9 and a 6% yield, I don't think it's terribly priced. And when you consider as well, there's going to be a decent sized buyback coming as well. So you're actually getting a much higher yield included in that price in the short term than that 6%. Yeah, I don't think it's terribly priced. It's not priced for growth. I know they've got the African side of the business, and like you say, that's tiny, but who knows? That might be a positive contributor in a significant way at some point. But if not, it doesn't really matter at 9 times earnings. So I think if you were looking for a decent dividend that's relatively secure, I think the newly reduced dividend I don't see it being reduced again anytime soon. And I think the reduction makes sense because it's a dividend that reflected other parts of the business being included that will no longer be there. So it's not even like it's been cut because the business is performing really poorly. It's been cut because parts of the business that were contributing to it are now going. So I think as an income investment, I think you can do a lot worse than a 6% yield from Vodafone.
Onto a business that has been delivering a lot of growth.
Yes, so we're now back to our final pharmaceutical company of the week, Novo Nordisk. So again, it's one we've covered multiple times before, and also one that we've touched on actually in your coverage of Diageo. So Novo Nordisk have come out with their full year results, and sales grew by 26% to 290.4 billion Danish kroner, and all these figures are in Danish kroners when ignoring currency movements. Growth was slightly ahead of market forecast, and that was underpinned by a 27% uplift in the core diabetics and obesity care division. Operating profit grew in line with sales to 128.3 billion kroner. Free cash flow fell from 68.3 billion inflow to an outflow of 14.7 billion as a ramp up in investment spending more than offset improved cash generation. At the year end, Novo Nordisk was carrying net debt of 76.5 billion kroner. Dividend payouts increased 21% to 50.6 billion Danish kroner, and share buybacks fell 33% to 20.2 billion. For 2025, sales growth is expected to be 16 to 24%, and operating profit growth is expected to be 19 to 27%, and the shares were up 3.2% following the announcement. The fastest growing products are the range of GLP-1 injections for the treatments of type 2 diabetes, Ozempic, and as a weight loss aid, Wegovy. Strong growth means the comparisons are getting harder and there's more emphasis on establishing further medical use cases. However, there's been recent approval to treat chronic kidney disease in diabetics, which should provide a boost, and management is also targeting application for approval in certain liver conditions in the first half of 2025. Recent clinical data from Wegovy's stablemate CagriSema was disappointing, and its potential launch date has been kicked down the line. Operating profit margins have been consistently over 40% for a while now. However, there is some downward pressure on pricing, especially the private cost of Wegovy, which is over $1,300 a month, and there are concerns this could impact profitability further down the line. Business now trades at a forward P of 21.3, and that compares to a 10-year average of 24. The business has a prospective dividend yield of 2.4% and a 10-year average of 2.1%. So, in terms of the share price, since we last covered it, although these results are pretty good, the share price has taken a battering. So it's down from about 800 Danish kroner to 558, and it's had a yearly high of over 1,000 actually. The main reason, as far as I could see, for why the share price had dropped, because as we've seen, these results are very good, but the main reason is concerns about competition for the GLP-1 drugs. So I think there was a big drop in share price around the time of the Super Bowl last week. And that was due to a Super Bowl ad from a rival GLP-1 company called Him and Hers Health. And that ran a high publicity ad, which basically was advertising medicines that duplicate the effects of Ozempic and Wegovy. So I don't really go back to the same point we've been talking about all show about the pipeline and how difficult these things are to analyze. So I did a Google of what the difference is, because Novo Nordisk's GLP-1 drugs are patented, and the patents were only taken out in 2020, so it seemed a bit odd to me that 5 years down the line, we're now worried about competition. So Him and Hers GLP-1 differs from Novo Nordisk's primarily because Him and Hers offers a compounded version of the drug, meaning it is made by mixing ingredients to create a customized formulation, while Novo Nordisk produces commercially manufactured, FDA-approved GLP-1 drugs like Ozempic and Wegovy, which are typically considered to have higher quality control and standardized dosages. Additionally, Him and Hers may offer a lower cost option due to their compounded nature, with potentially less research backing on efficacy and safety compared to Novo Nordisk products. So I think if this Him and Hers one is going to market and it does a similar thing at a fraction of the cost, I think this is a big problem for Novo Nordisk. And if other companies can do similar things without infringing on the patent, I can see why the PE has been cut all the way down to 21. That being said, I think for a business of this quality, operating margins over 40%, which is something where AstraZeneca, which is probably the best performer in the UK, they're not even targeting 40%. They're targeting mid-30s. GSK, I don't think they're anywhere near 40%, although they are doing better now. But it does show the quality of the business. I think at 21, it's probably looking a lot more attractive actually than the last time we covered it. However, I don't really, when I'm having to Google what the difference between these drugs are, and I'm just having to take Google's AI overview description as gospel because I don't understand it, that's a sign that I just shouldn't be investing in it. But Novo Nordisk looks like a quality business. I think the results are excellent, but I also appreciate that the Him and Hers news is concerning. John, what are your thoughts?
Yeah, I would agree with you on that. I mean, there are other big pharma companies that do have GLP-1s. There's something called Monjaro that's an example. So it's not as though there was no competition anyway. But I think also what you would worry about, particularly with Novo Nordisk, is when they come off patent and that being an issue for them. And where does the growth come going forward? I appreciate you might get new generations of GLP-1s, which could be even better, and perhaps that's the answer. Perhaps they have other things in the pipeline. I don't know. I think it on the surface of it, excellent company, but I think there is that inherent risk there. And again, do you take a basket approach with the pharmaceuticals?
Shall we move on to a favorite of the show, possibly the favorite of the show?
Yes, and much easier to understand. Walt Disney, they had their Q1 results out with first quarter revenue growing by 5% to $24.7 billion. In the entertainment division, declines in linear or traditional TV networks were more than offset by a 9% growth in direct-to-consumer content, which includes Disney's streaming brands. Experience, which included the theme parks, rose by 3%, and sports were broadly flat. Operating profit rose 31% to $5.1 billion, 15% ahead of expected, with the consumer and licensing segments unprofitable quarters last year. Free cash flow fell 17% to $739 million due to much higher levels of investment, and net debt was broadly flat over the quarter, ending at $39.8 billion. Disney Plus subscribers fell 1% from the start of the quarter, and the company expects modest decline over the second quarter. There was no change to full year guidance, and looking towards the high single-digit underlying EPS growth. And the shares were broadly flat in early trading. In terms of valuation, Disney has a market cap of $197 billion and trades at 20 times forward earnings, compared with the 10-year average of 23.5, and it has a prospective dividend yield of 0.9%. I thought these results were all right. I think fair in terms of revenue growth. I think it's positive with the 9% growth coming from the direct consumer content. But it is, I think, a bit concerning that the subscribers are dropping. I appreciate it's only very small, but I think when you look at the Netflix numbers, that's something that you probably shouldn't be seeing from Disney, and a bit of a worry. I think hopefully if you can get things going more with the parks, which have always been a more cyclical part of the business, that would be great. And I think as a whole, the turnaround under Iger is taking shape now. But little bit concerned about the subscriber numbers for Disney Plus. Sam, what are your thoughts on Disney and this set of results?
Pretty similar. I think the drop in subscribers was expected, given that they made it clear they're going to start ramping up the prices. But I do take your point that the Netflix results are excellent, and Netflix have been raising prices consistently over the last few years and growing subscribers. And Disney is actually still, I think, quite a lot cheaper than Netflix in terms of the cost of it. So if Netflix can do it off a much larger base, I don't see why Disney can't do it. So then you come to the question of, well, why is it? And I think the only answer you can come to is, well, it's the content, which I think isn't really good enough, to be honest, because I think the brands are so good and the IP is so good that the content should reflect that. As a Disney Plus subscriber, I think that's probably the reality. I only really occasionally I'll watch something else, but generally I will only really watch Star Wars stuff on my Disney Plus subscription. However, some of the Star Wars stuff that's been put out has been, well, it's been pretty mixed. I think some of the stuff Disney have done since they bought the brand has been excellent, and some of it's been less excellent. So I can sort of see why it's happening. However, I think at 20 times earnings for a business of this quality with these brands, I think you're doing pretty well. My other gripe would be, again, in the time we've been covering it, I think the debt's kind of hovered around 40 billion. Most of that's kind of debt left over from the Fox acquisition. But it would be nice to see them chipping away at the debt, especially when the dividend, I mean, they must be paying, I don't know what the dividend is, but the dividend is so tiny anyway. You know, just start chipping away at it, especially now interest rates are a bit higher. It would be nice to see the debt coming down. But yeah, I think it's a decent quarter. I think the strategy of raising prices seems to be working, and the operating profit increase of 31% we definitely can't complain about. But I do echo your point. I don't see why they shouldn't be growing subscribers as well as raising prices if the content is good enough.
Fair enough. So, of the companies this week, what would be your top pick and what would be last?
So I think top pick, I think I'd go with Diageo actually. I really like Disney, but I think at 17 times earnings, I think Diageo is worth a look. And I think a lot of the concerns are slightly overblown. And I think that will be reflected if they have if they can put out a couple of good halves. I think it's soon back at 25 times earnings with some very, very high quality brands. Least favorite, I think I'd probably rank AstraZeneca, GSK, and Novo Nordisk equally, but that is just because I'm not able to understand the pipelines, and that just makes all three of them uninvestable. That being said, all three are putting up quite decent numbers, and I think all three look fairly reasonably valued at the moment. And if I were to do it like you, I would just take a basket approach so that I didn't need to worry about the pipeline as much. What about you?
Yeah, I would, without sounding boring, I would go for Diageo. I think in terms of valuation at the moment, it's certainly more attractive. In terms of last, I would probably single out GSK. I think it's probably done the least over the last 10 years. And that trend, whilst better, is kind of continuing. So that would be, yeah, the bottom of the pile.
I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.